Our guest tonight, Bill Smead, says every year has its GDP ups and downs, but he remains optimistic about the economy and the markets for the long term. He's CEO and Chief Investment Officer at Smead Capital Management. Bill, welcome back. Good to have you with us. Let's talk a little bit about the economy and how weather may affect it here in the first quarter. I was at a conference a couple of days ago where everybody was saying, expect some real lumpiness, bumpiness in some of the numbers, and they won't really be trustworthy in the first quarter. What do you think?
Well, that could be accurate. There's things like this in individual quarters that happen almost every year. A few years ago, the federal government was such a net drag on GDP because of the way they were having to rein in employees and rein in spending, that was a real drag. And so we had a few, in 2010, 2011, 2012, we had 3 different stages of worrying about double-dip recession and so forth. It's just a bump in the road. I don't know how many people have extrapolated all the extra babies that we might have 9 months from now. The last time New York City had a brownout, I think they had a record-setting number of babies. And these storms are trapping people indoors, and so you just don't know. But the irony is the way the market's traded, it has had an impact because they feel like the QE is not going to get sped up, and a lot of people participate in this market under the assumption that the only thing going for it is the Fed. So when they feel good about the Fed, they buy stocks, and when they get nervous about the economy being strong enough to not need the Fed, they back away.
You do maintain, Bill, though, do you not, that basically large cap U.S. stocks are under-owned by some of the wealthiest investors out there, and perhaps the average investor as well?
Yeah, for example, Harvard's endowment was in a major publication over the weekend explaining to people that they have 11% of their $30+ billion portfolio in U.S. long-only equity. And we know from studies like the Nakubo Common Fund of endowments that 52% in long U.S. equity was average for institutions back, say, in 2002. So the idea that you can have a wicked, vicious bear market and massive sell-off usually means to sell off, you had to be on, and we think the largest pools of money in the world, especially U.S. institutions, aren't on, therefore it's hard for them to get off. In the meantime, speculators could do to get their ears pinned back because there's been a lot of frothy activity.
You have identified several S&P sectors that you like, and several that you really don't, including energy, basic materials, industrials, utilities, and telecom. Those are largely defensive sectors. So I assume you're in technology, you're in medical, you're in consumer discretionary. Am I right?
Well, you're on the right track. We're actually fairly lightly involved in technology through eBay and Accenture, who are basically technology agnostic. So our biggest overweights are consumer discretionary, which has been a very contrary and lonely trade. We've been overweighted there for 5 years, and financials and healthcare. It's really easy to think about our portfolio. There's 86 million Americans between 18 and 37, and we think they're going to come out of the deep freeze of the 5-year engagement and start living their lives. So that means a lot of economic growth engine from buying houses, cars, et cetera. So we're very positive longer term about the economy. And secondarily, my group, the baby boomers, we want to provide all the medicine that I'm going to need for the next 30 years to deal with my chronic illnesses.
All right, very, very quickly, got 30 seconds. Is the correction over, or is there going to be another one?
Well, no, we think it's a corrective phase that could last as long as 6 months.
Okay, great. Bill, thank you very much. We appreciate your time tonight. Bill Smead with Smead Capital Management.